If you search online or look up the basic definition of the stock exchange, it will tell you something like this: a stock exchange is a platform where people buy and sell the shares of stocks. Search more, and you'll learn something like, the stock market is where companies have their stock listed, and investors can go through any stock they choose to buy. This definition may not really be for you to understand what a stock exchange is. This is because the stock market, and other trading-related activities are usually taught to make it necessary to have financial, or technical background knowledge. However, our team at Stocks-Telegraph will show you the simplest ways to understand the stock exchange without making it overly complicated. Let's start with an example. Imagine you are at a science fair, and many teams are participating in this science fair. You and other visitors are here to see which team presents a new and successful-seeming project. Each group presents their science model. Then one of the teams presents a very attractive, promising model or wins top prize at the fair. This model prompts you and others to somehow invest in it, in hopes to see that the future success of this model in the market, and the public may bring profitable returns for your investment. The stock market operates in a similar way. Like a science fair, as we discussed early, the stock market brings buyers and sellers together. In a science fair, the teams presenting their models are similar to companies. These companies place their stocks on the stock exchange's listing. The visitors and participators who want to invest in the team's models are similar to buyers, or investors who wish to invest in the company's stock. Of course, this was just an example to visually explain how a stock exchange works in the simplest of ways. However, many other aspects of the stock exchange that we would like to cover are not part of this comparison. Next, let's look at what types of stock exchanges there are. There are mainly two types of exchanges. First is the centralized physical location of the stock exchange, where buyers and sellers verbally communicate, and physically exchange shares of stock. These physical exchange platforms are called auction-based exchanges, and the traders are physically on the exchange floor. The second type of stock exchange that exists is electronic-based platforms, where exchanges take place electronically. Due to this, traders no longer require a centralized physical platform. Out of these major stock exchange types, the electronic stock exchange is considered much more efficient. Recently, more and more stock exchanges are phasing out the auction-based exchange system for the electronic exchange platform. We will learn more about the type of stock exchange by going over the world's two most famous stock exchanges, starting with the New York Stock Exchange, one of the world's largest physically traded stock exchanges. It is also the largest equities exchange globally and in Wall Street, known as the Big Board since its origination in 1792. New York Stock Exchange transformed from a private to a public entity in March of 2006. Intercontinental Exchange mainly owns it. The NYSE offers both electrical exchange platforms and an auction-based exchange platform. At the physical exchange floor of the NYSE, a variety of market makers are designated to trade different types of stocks. As the auction floor opens up, these deal makers physically communicate with the buyers and sellers. Meanwhile, let's look at the world of the electronic exchange realm. We will specifically focus on NASDAQ, the largest electronic-based stock exchange in the world. NASDAQ stands for National Association of Securities Dealers, which was established in 1971. It consists of deal makers that are connected with stock buyers and stock sellers. You can see NASDAQ stock listings through electronic channels, such as a screen or a computer. It places deals through a certain type of trader known as the market makers or dealers. These dealers can be individuals or firms that make deals incentivized for their benefits. They generate by selling shares at higher bids and buying quotes at a cheaper bid. Now that you know about these two stock exchanges. Following that, let us find out how stock exchanges work. This includes regulations and requirements for companies that are listed. Stock exchanges like NASDAQ and NYSE have regulations and eligibility criteria for the enlisted stocks. If certain stocks of companies fall off the exchange requirements and eligibility criteria, they are removed or delisted from the exchange. The general requirements of these stock markets include the initial listing consideration fees and the entry fees upon successful listing. These fees can range between tens and thousands of dollars. The number of stockholders, and stockholders' equity must also meet minimum requirements. These restrictions are precisely placed to ensure that the stocks can maintain their credibility for all those involved in the stock exchange. Investors and traders automatically realize that these exchanges only list companies with a track record of good corporate and financial management. Furthermore, these exchanges then also require the listed companies to provide maintenance fees as part of an ongoing minimum standard. When a company does not meet these ongoing requirements, they notice non-compliance or deficiency notice. After a certain period, like 90 days in the case of NASDAQ, these companies are then delisted from the stock exchange, if not brought back to the standard. One of the most important ongoing requirements includes the minimum bid price and minimum market value of a specific stock. Additionally, there are other regulatory requirements on these stock exchanges, and stocks placed by the government or financial regulatory bodies. For example, the Securities and Exchange Commission, known as the SEC, specifically has stringent fair and transparent trading requirements on the stock exchanges. Penalties and repercussions, including blacklisting the company, heavy fines, and criminal charges, are some of the punishments imposed if companies don't comply with SEC regulations. Other markets for stocks where buyers and sellers can get shares are known as the over-the-counter market or OTC. OTC markets are used by companies that do not qualify for exchange listings or have been delisted. However, OTC markets have less stringent and credibility check requirements for the companies listed on them. This makes the background info on the company's management and activities less transparent. Pink sheets are another type of market service for trading. Here, quotation services are provided. Despite this, these market services do not necessarily require companies to register with the Securities and Exchange Commission. These companies do not have to report their filings periodically, making pink sheets even riskier than OTC. What we have shown you until now are all the fundamental components and procedures in the stock market. Now, let's see how all these pieces fit together to make up the real stock exchange. To list on a stock exchange, a company must first comply with the listing procedure. Once deemed eligible in the stock exchange, it is then officially known as a publicly traded company. The publicly traded company has to provide an initial public offering of its stock. In an IPO, the stock price is determined by the demand and supply of its stock shares. Our previous video covered more about IPOs, so if you have not watched it, please click on the top right corner to watch the first part of this video. The company is now listed on the stock exchange. Subsequently, the public can now invest in the company through its stock. Various other players in the stock exchange, like deal makers and brokers, will start trading the share of this company's stock. The company has to make sure that it complies with the ongoing requirements of the stock exchange and the regulations set by the SEC. The stock exchange is an excellent way for companies to expand and grow their investments publicly. We have now covered all aspects of what a stock exchange is, the types, and the underlying mechanisms that make it work. This is the second video in our Stock Market for Dummies series. We hope you liked the video, and if you have any questions, please feel free to comment below. The Stocks-Telegraph team will reply as soon as possible. Be sure to watch the upcoming video where we will explain what are the types of stocks in the stock market. To get the latest updates on market trends, news, and educational content, subscribe to the channel and press the bell icon.